We've talked in the past about householding finances, beginning the process of combining money when you start living with a partner or somebody else. Obviously, a lot of times that leads to marriage. Marriage is fun, it's a big party, but it also comes with a financial to do list of three things that I think really need to be addressed. So, number one is going to be taxes. I can't tell you how many times I've had a newly married couple in front of me asking me, Curtis, how should I file my taxes this year? So, my disclaimer here is that any good financial planner or professional is going to be able to tell you exactly where their expertise ends. And I am not a tax accountant. I'm not a CPA. So I'm not going to be able to give you exactly specifically what you should do or how you should file. You should definitely talk to an accountant. But that said, I have a lot of experience around this area, so I can give you a general perspective of how the tax code tends to apply in this situation. First things first, the way the tax code is written, the marriage status at the end of the year, on the last day of the year, is going to determine your marriage status for the entire year. So if you're married at any point in a given tax year, then you are going to be married for that tax year. You're going to have two options. Number one is going to be married filing jointly. Number two is going to be married filing separately. And again, talk to a tax professional for an exact breakdown, but I can tell you from experience, married filing separately, more often than not, is going to result in more taxes being paid. That's just sort of the way it works. That said, there are three situations to look out for that should really flag you as, married filing separately, even though it will result in more taxes in all likelihood, might be in our best interest here. Number one is if you have income-driven student loan payments. So if you have student loans, a lot of the times the amount of your payment is going to be tied to your income. In that situation, because it's income-driven repayment, the amount of your payment is going to be tied to the amount of your income. So if you're single and you have an income-driven repayment, and then you marry somebody with substantially higher income, that could result in your income-driven repayment going up. That might be an instance where it makes sense to consider married filing separately. But even if it keeps your payment down, it's still likely going to result in higher taxes. The second set of circumstances where married filing separately can make sense is if your partner has a risky tax liability situation. You might not want to be on the hook for that. Filing separately will keep that liability separate. So if you're married filing jointly, you are going to be on the hook for that tax liability. Filing separately would keep that liability separate. The third is medical expenses. If you have really high medical expenses, the ability to deduct those medical expenses from your income taxes is tied to an income floor. So if your income is relatively lower, below that income floor, and then you marry somebody that puts your income above that income floor, then filing jointly might lose you the opportunity to deduct those medical expenses. Again, those are three situations to look out for. But as always, you should talk to a tax professional and make sure you are taking the best route that applies to your specific set of circumstances. The second thing that should always be addressed when you get married is health insurance. Marriage in the health insurance world is a triggering event. That means that you can make changes to your policy now as a result of a marriage. Typically, it's going to be cheaper to have a spouse on the same policy as you, as opposed to maintaining two separate policies. Now, certainly every policy is a little bit different, so you're going to want to check the ins and outs of what you're giving up versus what you're getting. From a strict cost analysis standpoint, it's likely going to be cheaper, so that at the very least should be investigated once you get married. The third thing that you should address is going to be your beneficiaries. And this probably gets overlooked the most because nobody wants to think about their death. But as we know, everybody passes away. Unfortunately, we deal with it a lot in our regular work. And the last thing you want to do is pass away and not have your beneficiaries the way they need to be. Hopefully, it's not an ex or a former spouse, because when you pass away, whoever is listed on a beneficiary is going to supersede any other instruction that you have. So as you can imagine, passing away and leaving the wrong beneficiary on an asset is nasty, nasty business. So I would recommend that anytime you get married, you definitely want to make sure all the beneficiaries are lined up. One thing to keep in mind is that with retirement accounts specifically, 401ks, IRAs, the IRS gives spouses a substantial benefit in the event that you pass away. So I pretty much always recommend that you list your spouse as the beneficiary on any retirement plan. I'm not going to go into what all those benefits are, but I pretty much always recommend that, and I very infrequently make blanket recommendations like that. But again, update your beneficiaries, make sure everything at the very least is in line with what you want to happen. So those are the three: taxes, health insurance, and beneficiaries. The three things that should be addressed the moment that you get married. None of those are particularly complicated individually. It's just a matter of making the time to go through them deliberately and to make sure that you're doing what's best for your circumstances.